So in 2025, we're seeing something massive happen in the global trucking industry. And this is the very backbone of our economy we're talking about. It's not just about building bigger or faster trucks anymore. No, this is what we're calling the Great Remoting. It's a time when the old ways of competing are basically falling apart, and new advantages are being built from software, from services, and from some really bold bets on new tech. So let's dive into this deep analysis from HDIN research and figure out what's really going on and who might come out on top.
And the stakes here could not be higher. Daimler Truck really nails it with this quote. This isn't just another industry, it's the engine that powers our entire society. So when this sector goes through a major change, believe me, everybody feels it.
All right, so here's how we're going to break this all down. First, we'll look at the growing financial gap between the big players. Then, we'll get into the huge debate, hydrogen or electric. After that, we'll see how software is really the new battleground, and then we'll decode some tricky but important details in the financial reports. And finally, we'll look ahead to what's shaping up to be a very uncertain 2026.
Okay, first up, the financial battleground. The data from 2025 is showing a real split is forming in the industry. It's becoming a tale of two tiers, with some companies absolutely crushing it, while others are, they're struggling. And this table right here lays it all out. Just look at Paccar, a rock-solid 8.37% net profit margin, and they're pulling in over $1 million in revenue for every single employee. That is just incredible efficiency. But then, you look over at Stellantis, and you see a negative 14.55% margin. Ouch. Even with massive revenues, they're losing money. It just goes to show you, it's not just about how many trucks you sell, it's about how good you are at turning those sales into actual profit.
So how are these companies navigating all this turbulence? Well, we're seeing two completely different game plans emerge. On one side, you have the Western companies like Daimler and Volvo. They're teaming up, forming joint ventures to share the huge costs and risks of developing new tech. But on the other side, you've got Chinese giants like Weichai and Sinotruk doing the exact opposite. They're going all in on vertical integration. They want to own and control every single piece of the puzzle themselves. Two totally different bets on how to succeed.
And that strategic split leads us straight into the biggest technology debate in the industry right now, the powertrain. We're talking about a multi-billion-dollar question here, and if you get the answer wrong, it could be absolutely catastrophic for your company.
This is it. This is the question on everyone's mind in every boardroom. Do you bet the farm on battery electric trucks, knowing that charging infrastructure is still a huge question mark? Or do you go with hydrogen, which is faster to refuel but has its own massive cost and infrastructure hurdles to overcome? Which way do you jump?
And then, in mid-2025, we got a huge signal. Stellantis just pulled the plug on their entire hydrogen fuel cell program. And their reasoning was pretty blunt. They basically said, look, the refueling stations just aren't there, and without big incentives for customers, widespread adoption is still a decade away. Maybe more.
And wow, look at the price tag for that decision, 1.1 billion euros. That's how much it cost them in charges to shut the program down. So this wasn't just some small course correction. This was a massive, expensive, and very public statement about where they don't see the future of trucking.
But hold on. Don't think that just because they're ditching hydrogen, everyone is going full speed ahead on battery electric. Not at all. A lot of other Western companies are actually tapping the brakes on their electric truck rollouts. Why? Well, because the real world is messy. They're pointing to the same problems, not enough chargers, and confusing, changing regulations. So yeah, this whole transition, it's going to be a slow, bumpy ride.
All right, so this brings us to a really critical shift that's happening. The strongest competitive advantages, the deepest moats in the trucking world, are no longer just being built out of steel. Now they're being written in code. The real power is shifting to software and services.
And there's a key word for this whole idea, servitization. Think of it this way. Instead of just a one-time big-ticket sale of a truck, it's more like a subscription model. You're creating a steady stream of revenue through services over the entire life of that vehicle. And why does this matter so much? Because that recurring revenue is the best defense you can have when the market inevitably takes a downturn.
You want to see proof? Look no further than Volvo's 2025 numbers. It was a tough year, and their new truck sales actually fell by 7%. But their service sales, they went up by 3%. That right there, that's the power we're talking about. It's a stable, high-margin business that cushions the blow when hardware sales slow down.
So what's the secret sauce? How do the top companies pull this off? Well, there's a pretty clear three-step playbook. Step 1, they use their own financing to get customers in the door. Step 2, They use software and telematics to help that customer save money over the long run. And step 3, they cash in by selling high-margin parts and services for the next 15 years.
It's all about locking that customer into a digital ecosystem. You see Daimler Truck doing it with platforms like Fleetboard and Detroit Connect. Over in China, FAW Zhifeng has its Zhifengsheng app. The big idea for all of them is to move from just fixing trucks when they break down to being able to predict a failure before it even happens, and then selling that predictive service as a monthly subscription.
Okay, let's roll up our sleeves a bit because now we're going to dive into the balance sheet. And I know this can get complex, but it's so important. This isn't about telling you what to buy or sell. It's about learning how to read between the lines and spot the things that really matter.
And just to be super clear here, this analysis is for informational purposes only. It's all based on the great work from HDIN research, and it is absolutely not investment advice. We just want to give you the tools to do your own sharp analysis.
So, looking at Stellantis, a couple of things really jumped out to analysts in 2025. First, they set aside a huge pile of cash, over $6 billion, for future warranty claims. Now, that can be a signal that the company is worried about potential quality issues down the line. Second, they adopted a new accounting standard early. That can sometimes make it tricky to compare their latest results to previous years. It's not always apples to apples.
Meanwhile, over at Tratton, the thing to watch is how they account for R&D. They used to track those costs for each of their brands, like Scania and MAN, separately. Now, they're just lumping it all together at the group level. Now, they say it's for efficiency, but the risk here, it kind of muddies the waters, making it tougher for an outsider to see which brands are truly pulling their own weight.
Okay, so we've looked at the financials, the technology, the different strategies. Where does this all leave us? What's the road ahead look like? Well, after a crazy 2025, if you had to sum up the industry's feeling about 2026 in one word, it would be uncertainty.
And don't just take my word for it. This quote from Tratton's own annual report really says it all. Basically, everyone is a lot less sure about what's going to happen next. They know there are a ton of big external factors that are just completely out of their control.
And what's keeping them up at night? Well, it's a whole laundry list of global headaches. You've got ongoing tensions between the US and China, potential trade wars with Europe, conflicts in the Middle East and Ukraine, and just a general trend towards protectionism. Any one of these could throw a massive wrench in the works, disrupting supply chains and hurting demand. The world just feels a lot more volatile right now.
And all of this leaves us with one final huge question. In an industry that's breaking apart along these new lines, who has the winning strategy? Is it the soloists, the vertically integrated companies who try to control every single instrument themselves? Or is it the orchestras, the ones who build partnerships to share the risks and rewards? The answer to that question is going to define the entire transportation industry for the next decade.